Alibaba was recently fined $2.78 billion for monopolistic behaviors in China. However, the stock market's reaction hasn't been what you would expect at all. So in this video, we want to take a closer look at the Amazon of China by exploring its financials and its business model in order to find out whether the stock is an attractive investment at the moment. So I hope you enjoy this video and let's jump right into it. As always, I want to give you a brief overview of the company first. The company currently has a market capitalization of $629.5 billion. It has 117,600 employees and it was founded in 1999. Alibaba is headquartered in Guangzhou, China, and it operates in 4 different branches: e-commerce, retail, entertainment, and tech. Alibaba has the mission to enable businesses to transform the way they market, sell, and operate and improve their efficiencies. Now let's take a look at the price chart here. If you had invested in Alibaba back in 2017, you'd be looking at a return of 187%, which is really nice. The lowest price was back in 2017 at $96 and the high at $309 at the end of 2020. Currently, the stock is sitting at around $230. Now let's take a look at the shareholders here. As we can see, there's a couple of institutional shareholders, but they all hold very small stakes in the company. Even the biggest institutional shareholder, Genesis Investment, holds a stake of only 0.14%. Insider ownership is also pretty low at around 0.23%, and the overall institutional ownership is at 43.86%. So we can see that there's actually quite a lot of private investors that have a stake in this company. Now let's take a look at Alibaba's last year income statement. So Alibaba increased their revenues from 376.8 billion Chinese yuan from 2019 to 509.71 billion Chinese yuan in 2020, which is a 35% increase. Their net income increased by a whopping 71% from 87.6 billion Chinese yuan to 149.2 billion Chinese yuan, which is really impressive. So this means that along the way, they decreased their operating expenses somewhere. Well, actually, their operating expenses did increase by 21%, but if you look at it as a percentage of gross profit, we can see that their operating expenses have been kept pretty low if you compare to the 2019 levels. Another thing that I like to see is that Alibaba is investing a lot in R&D. It has increased its spending on R&D from 37 billion to 43 billion in 2020, which is a 16% increase, which means that the company is placing a lot of emphasis on innovation, which is always nice to see. Now, looking at the evolution over the past 4 years, we can see that profit margin has been kept pretty stable. It was around 30% in 2017, and now it's around 31%. So we can see that revenue has been increasing over time, exponentially actually, and net income has also increased a pretty decent amount with it. Now, looking at debt to assets, we can see that their debt to assets ratio has actually decreased a little, which means that they've been increasing their assets by quite a bit, but their liabilities not as much. Now, looking at their cash flows, we can see that their operating and financing cash flows have been increased over the past 4 years, which is very nice. Just as a reminder, operating cash flow is just a measure of the amount of cash generated by a company's normal business operations. And if we look at investing cash flows, we can see that they've decreased slightly. So, cash flows from investing activities is just a section of the cash flow statement as well, which shows the cash generated or spent relating to investment activities. And investment activities could include things like purchases of physical assets, investments in securities, or the sale of securities or assets. And what this tells us is that Alibaba hasn't been generating as much cash from their investments as in 2017, but it's still at a very decent level, I would say. So nothing to worry about at this stage. All right, looking at their valuation, we can see that Alibaba is relatively cheap to some of its competitors, especially JD. We're looking at a PE ratio of 24.82, and if we compare that to JD's PE ratio of 206, it becomes apparent that Alibaba is very cheap at the moment. But now if we compare that to eBay, we can see that it's still a bit more expensive. Overall, we can say that Alibaba isn't neither very expensive nor very cheap. It's just a normal valuation for such a successful company in the tech sector. And if we look at its price to free cash flow ratio, actually, we can see that the valuation isn't as bad. Looking at their liquidity and debt levels, we can see that the company is quite liquid. Its current ratio is 1.67, as well as its quick ratio, and its cash ratio sits at 1.5. Usually what we want to see is a current ratio of between 1.2 to 2, and Alibaba is sitting right at the middle of it, which is a very nice thing to see. And what this means is that Alibaba is not at risk of running out of cash in the near future, or running out of current assets, liquidity to pay for debts, for example, which is very good because that means that it's at no risk of bankruptcy. Now let's look at Alibaba's business model canvas. This always gives us a very nice overview of some of the things that Alibaba is doing. So let's start with the key partners. Of course, here the government has to be mentioned because it's a Chinese company, and for any Chinese company that does not seek to have the government as its partner, well, it's not going to end well. And Alibaba actually has had this problem over the past couple of months where they've been kind of in a quarrel with the Chinese government, which is probably also one of the reasons why they've been hit with such a huge fine just a couple of days ago. Looking at their key resources, we can see, of course, they have their e-commerce platforms such as AliExpress and Alibaba, and they use big data in order to improve their algorithms to, suggest better products or products that fit the user's interests. And they also have, of course, intellectual property and cloud computing, which are key resources that drive some of the growth of the company. Looking at their key activities, of course, they have to provide good customer service. They also, take care of the logistics, R&D, and innovation. And they need to expand network effects on both sides in order to get more users onto the platform so that more businesses want to come on as well and sell their products so that Alibaba can earn a commission. Some of the main channels include websites, affiliates, apps, payment systems, which are very efficient, very cheap, and used especially in China, and the media. Looking at customer relationships, we have to look at personalized service, automation, online money transfers, and as I mentioned before, demand and cross-site network effects. Now, what kind of benefits do users of Alibaba or also businesses get out of the services that they provide? Well, for the user side, they have, of course, range of products. They get entertainment services through digital media and digital payment services, which are very immediate and very cheap. For businesses, there's of course the opportunity to market their products globally and to use cloud computing services. Now, where do some of the costs come from? Well, of course, we have huge warehouses where Alibaba needs to store some of the products that it sells on these retail platforms. Then there's data centers that they need to maintain in order to provide cloud computing services. There's a lot of logistics going on with the shipping of these products that they sell through some of the platforms like AliExpress. marketing, and of course, some acquisitions that they've done in the past. Now there's 4 major revenue streams here. We have retail sales, of course, on which AliExpress also sometimes earns commissions. Then there's listing fees, and there's subscriptions to their media services. And taking a closer look at these revenue streams, we can see that core commerce still makes up about 84% of Alibaba's revenues, but cloud computing is the second biggest segment here. And if you look down below at the growth, we can actually see that core commerce is growing at a very good 29%, but cloud computing is growing at a whopping 60%. So we can assume that Alibaba is very interested in expanding its presence in this segment. Digital media is not growing as much, but still a very nice 8% growth rate annually. Now let's take a closer look at these 3 segments that we just talked about. So the core commerce is primarily derived from Chinese retail marketplaces such as Freshippo, 1688.com, Lazada.com, AliExpress, Alibaba.com, local consumer services, and Cainiao logistics services. The cloud computing, also called Alibaba Cloud or known as Aliyun, is a cloud computing service that provides online businesses with the opportunity to use these services in order to shift some of their processing to AliExpress and to probably get a better rate than buying these servers themselves. Looking at digital media, we have 2 major income streams here, which is Youku, which is a video hosting service based in Beijing, and some online games that Alibaba also offers. And now let's get back to the title of the video, to the beginning, when we talked about the recent news where Alibaba was fined $2.78 billion for monopolistic behaviors in China. So these news actually came out on the 9th of April. So this was last Friday. And what does this mean for Alibaba? Well, it means that Alibaba now has to rectify the company's practices and to self-examine over the next 3 years. As we can see down below, the same-day reaction to these news wasn't actually too bad. It was just a drop of 0.68%. And if we look at today's reaction, we can see that the stock is actually jumping at 9.51%, which isn't really what you would expect. But if you take a closer look, it becomes apparent why people are so interested in investing in this company now, because investors were really happy about the response that Alibaba gave to the Chinese government. They actually said that Alibaba accepts the penalty with sincerity and will ensure its compliance with determination. And despite the record fine amount, this really lifts a major overhang on Baba, and it really shifts the main focus back to the financials and not to this, overhanging risk that was sort of very apparent over the past months. And now that it's finally over, investors know what Alibaba has to deal with. There's a lot less uncertainty about Alibaba's future, which is always what investors are looking for, of course. Now let's look at some of the institutional transactions that have happened over the past 2 quarters. We can see that especially in the last quarter of 2020, a lot of institutional investors reduced or trimmed their positions quite a bit. We can see 91 North America trimming their position by 99.84%, so pretty huge amounts here. But we can see in the recent past that more and more institutional investors have started investing in this company with Nuav Investment Management or Daily Journal Corp, which just recently opened a position in this company. And these institutional investors were just trimming their positions because of these concerns that we just talked about, with the risk of the Chinese government hitting Alibaba with a huge fine and some repercussions because of the monopoly that it's holding in some sectors. But now that it's over, I I firmly believe that more and more institutional investors are going to jump back on this stock and, you know, um, just buy a lot more of it than they have been in the past few months. And this is also a picture that we get from the analyst ratings here. We can see that analysts are pretty bullish on the stock, a 1.7 rating, almost a strong buy, and the average price target of 322 definitely promises some huge upside on the stock. And this brings us to our conclusion. So the projected upside, according to these analysts, would actually be 32%, which is really nice. And now let's look at some of the pros and cons that we've talked about in this video. So starting with the pros, we of course have to mention that, you know, the company has huge market shares in the e-commerce and cloud computing sectors. It's growing, you know, steadily and a lot over the past years, and it's going to continue to grow because it's a strong innovator with a diversified portfolio, especially if you compare it to Facebook, which we analyzed yesterday. We can see that Alibaba is definitely more diversified in terms of its revenue streams, which is always a good thing to see. Looking at some of their cons, of course, there's the continued country risk because the Chinese government, you know, continues to have a lot of power as an authoritarian government. They can easily take down any company that, you know, is not really following their laws and what they want to see in a company. So this continues to be a risk. And then, as I mentioned before, the company is valued not very cheaply. I wouldn't say it's a very high valuation, but, you know, compared to, as we saw, eBay, for example, the valuation is on the higher side. So overall, Alibaba gets a total score of 31 out of 50, which, you know, means that the company could definitely be an interesting investment here. All right, thanks for watching, and see you next time, and let me know in the comments what you guys think about Alibaba.